So how is Money Works for Me way of selecting a Sahi fund different from the current way?
So looking at the past returns and investing in today's best performers, which is the current way of investing, is a recipe for disappointment. It's grossly inadequate. It's like driving a car looking at the rear view mirror. It doesn't work. So as a fiduciary advisor, we set out to find out the Sahi way of investing in mutual funds. As an investor, you need to know three things before you can invest in a mutual fund. First, the quality of the underlying assets and the risk it is carrying, and how does it compare to its benchmark. Second, consistency of returns generated compared to the benchmark. Investors enter a mutual fund at different times and hold it for different period. A Sahi fund needs to deliver consistent returns immaterial of when the investor has entered the fund. Of course, provided he holds it for a reasonable period of time. Lastly, a fund's expense ratio in comparison to the total excess returns it has generated over its benchmark has to justify our investment and paying fees. We generate scores for each of these parameters, and based on that, the overall score for each mutual fund, and rank them within their category to find the Sahi funds. We have color coded them. Green for the top 20%, followed by orange for the next 30%, and lastly red for the bottom 50%. You should look at the videos of our expert analysts to get a deeper appreciation on how to use the free features available on our site and identify the Sahi mutual fund.
But how does one know what is the right price or a right time to enter the fund?
Yes, so once you have found a Sahi fund, it is important to know what is the right price or the right time to enter into a fund. That's because a fund is nothing but a collection of stocks. And if many of these stocks are highly overpriced, then your returns are likely to be low. Therefore, it doesn't make sense to buy this fund at a high price. A minimum reasonable time to stay invested in a mutual fund is about 3 years. We look at the returns a fund is likely to generate in this period with its current portfolio and at current prices. We call this its potential upside. We do the same for the benchmark index, and then we compare. If the potential upside of the fund is higher than its benchmark index, then it is the right price or time to invest in the mutual fund. We also compare with the returns that you are likely to get from a fixed deposit or a liquid fund, and it has to necessarily exceed that. Of course, we must also compare other mutual funds in the same category and pick the best one. We have been able to do this because we have been valuing stocks, finding its MRP for the last 10 years. And this gives us a unique advantage to assess the potential upside of a fund. I suggest you look at the videos of our analysts to understand how to look at returns.
How much to allocate to a particular fund? I mean, what is the right allocation?
Good question. This is again not as simple as it is made out to be. See, why do we invest in a mutual fund? Because we want to diversify our portfolio and reduce the risk, and also to increase the risk-adjusted returns that we get from our portfolio. A mutual fund may be Sahi, but it is Sahi for you when it complements your portfolio. That is, it helps in diversifying and reducing your risk and or enhancing the risk-adjusted returns that you can get from your portfolio. This is what we look at before recommending a mutual fund to our customers.